If gold has just pushed through $4,600 while silver is accelerating higher at the same time, then something much bigger may be happening beneath the surface. The headline number is impressive. But the real story is not simply that gold is rising. The real story is what is happening to the foundation underneath the dollar and the U.S. Treasury market. The United States has now crossed a historic debt milestone above $40 trillion. At the same time, long-term Treasury yields are under pressure, and investors are questioning how easily the government can keep borrowing at this pace. That combination matters for gold and silver more than most people realize. And this is where things become very interesting. Gold is not just reacting to inflation. Silver is not just following gold. Both metals are responding to a changing view of money risk and government debt. When confidence in traditional financial assets becomes less certain, investors often begin looking for assets that cannot be created with a computer keyboard. Gold has filled that role for thousands of years. Silver has done it too, while also carrying a huge industrial demand story. So when both metals begin moving together, the signal deserves attention. The first thing to understand is the $40 trillion debt milestone. The Treasury reported total U.S. public debt above $40 trillion in August. The figure was about $40.047 trillion when the milestone was reached. That number includes debt held by the public as well as government holdings. It is a level that would have sounded almost impossible only a generation ago. Yet here we are. The important point is not that the United States has suddenly become unable to pay its bills. That is not what this number means. The United States still has enormous economic power. It still has the world's largest capital markets. The dollar remains the dominant reserve currency. Treasury securities remain central to global finance. The problem is the direction of travel. Debt becomes more difficult when interest costs rise. A government can carry a large debt load when borrowing costs are low. But when interest rates stay high, the cost of servicing that debt can become a much larger part of the budget. That creates pressure from several directions at once. The government needs to borrow more to cover deficits. Existing debt has to be refinanced over time. New debt has to attract buyers. Investors then demand compensation for inflation risk and fiscal risk. That can push yields higher. Higher yields then make new borrowing more expensive. This creates a feedback loop that investors watch very closely. That is one reason the Treasury market matters so much for gold. Gold does not pay interest. Treasury bonds do. So when Treasury yields rise sharply, gold can face pressure because investors have a stronger alternative. But there is another side to the equation. If rising yields are caused by fear about government borrowing and inflation, then the same yields can eventually make gold more attractive. This sounds contradictory, but markets often work this way. Imagine an investor looking at a 10-year Treasury. The yield may look attractive. But then the investor asks a simple question. What happens if inflation stays higher than expected? What happens if the government keeps borrowing at a rapid pace? What happens if the dollar loses purchasing power? What happens if long-term rates remain unstable? That investor may still own treasuries, but the investor may also want something outside the credit system. That is where gold enters the conversation. Recent market action has made this issue even more important. Gold recently moved sharply higher as Treasury yields and the dollar came under pressure. COMEX gold settled above $4,500 on August 20th. Silver also jumped and settled around $68. Other market reports have since described gold trading around the mid-$4,600 area. That means the broader trend remains highly volatile and powerful. So when you see a title saying gold just hit $4,616, you should not focus only on the number. Ask what caused the move. Ask what happened to bond yields. Ask what happened to the dollar. Ask what investors expect from the Federal Reserve. Then ask what the debt market is telling us. That last question may be the most important one. The Federal Reserve has a difficult job. It needs to control inflation while also trying to maintain economic stability. Normally, those objectives can be managed with interest rates, but a massive debt burden makes the environment more complicated. Higher interest rates can help fight inflation. They can also support the dollar. But higher rates make government borrowing more expensive. Lower rates can reduce the pressure on debt servicing, but lower rates can weaken the dollar and potentially create more inflation pressure if economic conditions are already hot. This creates a delicate balance. Investors therefore watch every Federal Reserve statement. They watch inflation data. They watch employment numbers. They watch consumer spending. They watch Treasury auctions. They watch the dollar index. They watch oil. They watch geopolitical developments. Gold watches all of these things too. But there is something else happening in the background. Central banks around the world have been increasing their interest in gold as a reserve asset. The motivation is simple. Gold does not depend on the creditworthiness of another government. It does not carry the same counterparty risk as a bond. It can be held as a reserve outside the traditional dollar system. That does not mean central banks are abandoning the dollar. It means many institutions are thinking about diversification. This distinction is important. When a central bank buys gold, it is not necessarily making a prediction that the dollar will collapse tomorrow. It may simply be reducing concentration risk. It may be protecting reserves against geopolitical uncertainty. It may be responding to changes in global trade. It may be preparing for a world where financial sanctions and currency restrictions have become more important. That long-term demand can provide support to gold even when short-term traders become nervous. Now bring silver into the picture. Silver is different. Gold is primarily a monetary metal and store of value. Silver is both a monetary metal and an industrial commodity. That gives silver a unique personality. It can rise because investors want precious metals. It can also rise because manufacturers need more silver. Silver is used in electronics, it is used in solar technology, it is used in electrical systems, it is used in advanced industrial applications. Demand can therefore grow even when investors are not buying coins or bars. This is why silver can sometimes move much faster than gold. Gold is the heavyweight, silver is the high beta metal. When the precious metals market becomes bullish, silver can accelerate because the market is smaller and the supply response can be slow. That creates another important signal. If gold rises while silver stays flat, then the market may be focused mainly on monetary protection. If gold rises and silver begins catching up, then the market may be moving into a broader precious metal cycle. And if silver starts outperforming gold, then traders begin watching the gold to silver ratio. That ratio tells us how many ounces of silver are required to buy 1 ounce of gold. When the ratio falls, it means silver is outperforming gold. When the ratio rises, it means gold is outperforming silver. This matters because silver can go through long periods where it looks cheap compared with gold. When the market suddenly recognizes that gap, the move can become explosive. That is why the current silver action deserves attention. Recent COMEX data showed silver climbing strongly alongside gold. Silver reached levels around $68 in late August after a sharp 2-day gain. The key question now is whether this is simply a short-term rally or the beginning of a much larger repricing. There are reasons to believe the market could remain volatile. The first reason is government debt. $40 trillion is not just a psychological milestone. It is a reminder that the U.S. fiscal position has become a major market variable. The debt has more than doubled from the level seen when Donald Trump first entered the White House in 2017. The second reason is interest costs. When rates stay elevated, the government has to pay more to refinance maturing debt and issue new securities. That does not automatically create a crisis, but it increases the sensitivity of the system to interest rates. The third reason is the bond market. The bond market is where the cost of government borrowing is determined. If investors demand higher yields, then the entire financial system feels it. Mortgage rates can rise, corporate borrowing can become more expensive, stock valuations can change, the dollar can react, gold can react. That is why gold investors should watch the 10-year Treasury yield, even if they never buy a bond. The fourth reason is inflation. Inflation does not need to explode for gold to benefit. It only needs to remain persistent enough to make investors question the real value of cash and fixed income. This is where real yields become important. If a Treasury bond pays 5% while inflation is 2%, then the investor may earn a strong real return before taxes and other factors. But if inflation rises while nominal yields remain stable, then the real return becomes smaller. Gold does not need to beat the nominal yield. It can benefit simply because investors become less confident about the purchasing power of money. The fifth reason is the dollar. Gold is priced in dollars. When the dollar weakens, gold often becomes easier for international buyers to purchase. That can increase demand. A weaker dollar can also reinforce the idea that investors should diversify away from dollar exposure. This creates an interesting relationship. A stronger dollar can pressure gold, a weaker dollar can support gold. But a stronger dollar caused by a global crisis can sometimes produce a different reaction because investors rush toward dollar liquidity. Markets are not mechanical. Context matters. The same is true for silver. Silver can fall during a recession because industrial demand expectations weaken. Yet silver can also rise during a recession if investors expect aggressive monetary easing and renewed demand for monetary metals. That is why silver requires more than one indicator. You have to watch manufacturing, you have to watch solar demand, you have to watch global growth, you have to watch investment flows, you have to watch gold, and you have to watch the dollar. Now, there is another major development that investors should not ignore. The U.S. Treasury has been using bond buybacks as part of its strategy to support market liquidity. Recent reports say Treasury Secretary Scott Bessent plans to increase purchases of longer-dated treasuries beginning in September. The objective is to improve market functioning, but investors can interpret such actions in different ways. Some may see them as a technical measure designed to improve liquidity. Others may worry that large-scale intervention signals stress in the bond market. That perception matters. Markets are driven by expectations. If investors believe the Treasury has to take stronger action to stabilize long-term bonds, then they may begin asking why the bond market needs that support in the first place. That question can push investors toward assets outside the traditional system. Gold is one of those assets. Bitcoin is another. Silver can benefit as well. This does not mean every Treasury action is bullish for precious metals. It means the market is becoming more sensitive to fiscal policy, and that sensitivity is likely to remain. There is also the Federal Reserve. The Fed cannot simply look at one number. It has to balance inflation with employment and financial stability. If inflation falls, then markets may expect rate cuts. Rate cut expectations can push bond yields lower. Lower yields can support gold. A weaker dollar can provide another boost. But if inflation stays high, then the Fed may remain cautious. That can push yields higher. Gold could face pressure. Yet if those higher yields are driven by concerns about government debt rather than strong economic growth, then gold can eventually react differently. This is why investors should separate monetary policy risk from fiscal risk. They are connected, but they are not identical. The Federal Reserve controls short-term monetary policy, the Treasury manages government financing, Congress controls spending and taxation. Markets price the interaction between all three. That interaction is becoming one of the biggest stories for gold and silver. So what happens next? There are several possible paths. One path is a continued precious metals rally. If Treasury yields fall and the dollar weakens, then gold could remain strong. If silver continues to attract investment demand and industrial demand, then silver could accelerate even faster. Another path is consolidation. After a huge move, the market may pause, traders may take profits, gold may move sideways while silver pulls back. This would not necessarily destroy the larger trend. In fact, healthy corrections can reduce excessive speculation and create a stronger foundation for another move. There is also a bearish path. If inflation falls sharply and the economy remains strong, then the Federal Reserve may keep policy tighter for longer. Treasury yields could remain elevated, the dollar could strengthen, gold could pull back. Silver could suffer an even larger percentage correction because of its higher volatility. That is why nobody should treat a price target as guaranteed. The key is to understand the forces behind the move. Gold at $4,600 is not simply a story about gold. Silver near $70 is not simply a story about silver. The bigger story is confidence. Confidence in the dollar, confidence in treasury bonds, confidence in fiscal policy, confidence in monetary policy, and confidence that inflation can be controlled without creating another financial problem. That is why the $40 trillion debt milestone matters. The United States still has enormous economic resources. It still has the world's most important financial markets. It still has a powerful currency. Nothing about crossing $40 trillion means the system suddenly stops working. But the margin for error becomes more important. When debt is small relative to the economy, a rise in interest rates may be manageable. When debt becomes enormous, the same rise in rates can create much larger interest costs. That changes investor psychology. And investor psychology can move gold and silver before the economic data fully confirms the trend. This is also why the next few months could be extremely important. Watch Treasury yields, watch the dollar, watch inflation, watch employment, watch Federal Reserve language, watch Treasury auctions, watch central bank gold demand, Watch silver industrial demand. Most importantly, watch whether gold and silver continue moving together. If gold stays strong while silver begins outperforming, then the precious metals market could be entering a different phase. That would suggest investors are moving beyond defensive gold buying and into a broader commodities and monetary metals trade. Silver could then become the more explosive part of the story. But there is a warning here: fast rallies create fast corrections. Silver can move several percentage points in a single session. Gold can also experience violent pullbacks after reaching new highs. That means investors should not confuse momentum with certainty. A strong chart does not guarantee the next move. A huge debt number does not guarantee a financial crisis. A weaker dollar does not guarantee endless gold gains. And a rising silver price does not guarantee that silver will keep rising every day. The smart approach is to understand the structure. The structure right now is built around three major forces. Debt is rising. Bond market pressure is increasing. Precious metals are attracting attention. That combination deserves respect. The most important question is not whether gold can go higher. The most important question is whether the reasons behind the rally are becoming stronger. If debt continues rising, if fiscal concerns continue, if long-term Treasury yields remain unstable, if the dollar weakens, if inflation stays persistent, if central banks continue accumulating gold, and if silver demand continues expanding, then the long-term case for precious metals can remain powerful. But if those conditions reverse, then the market can change quickly. This is where the next major move could be decided. The market is entering a period where investors cannot look at gold in isolation. They need to watch the entire monetary system: the debt, the bonds, the dollar, the Fed, the inflation data, the global economy, and silver. Because silver may be the metal that tells us whether this is simply a gold rally or the beginning of something much larger. Think about what has happened. Gold has moved into a completely different price environment compared with previous years. Silver has pushed into levels that would have seemed extraordinary during the old precious metals cycle, and now the United States has crossed $40 trillion of national debt. That does not prove that gold must rise forever. It does prove that the financial environment has changed. And when the environment changes, investors have to change the questions they ask. Instead of asking whether gold is expensive, ask what the dollar is worth. Instead of asking whether silver has already moved too far, ask whether supply can keep up with demand. Instead of asking whether Treasury yields are high, ask why investors are demanding those yields. Instead of asking whether the Fed can cut rates, ask whether the Fed has enough room to respond to the next shock. Those questions can tell you much more than a single headline. The next major move in gold and silver may not come from a dramatic Fed announcement. It may come from the bond market. It may come from inflation. It may come from a Treasury auction. It may come from a sudden dollar move. It may come from geopolitics, or it may come from a combination of all of them at once. That is what makes this moment so important. Gold at $4,616 would be a major psychological milestone. Silver surging towards $70 would be another. But the $40 trillion debt milestone is the number that changes the conversation. It tells us that fiscal policy is no longer a background issue. It is becoming a market driver. And if investors begin demanding a larger risk premium to hold long-term U.S. debt, then the consequences can spread across every major asset class. Stocks can react, bonds can react, currencies can react, commodities can react, and precious metals can react. That is why this story is much bigger than one gold price. It is about the price of confidence. The next chapter will be written by the bond market. If yields stabilize and the dollar strengthens, then gold and silver may need to cool down. If yields fall and the dollar weakens, then precious metals could receive another powerful boost. If inflation remains sticky while fiscal concerns grow, then the market could face an especially unusual environment where gold rises even while nominal rates remain elevated. And if silver continues outperforming gold, then we could be looking at the early stages of a much broader silver repricing. For investors watching this market, the message is simple. Do not chase headlines. Understand the forces behind them. Watch the dollar. Watch the Fed. Watch Treasury yields. Watch inflation. Watch debt. Watch gold. And watch silver. Because the biggest moves often begin before the majority of investors understand why they are happening. The United States has now crossed a debt level that once sounded unimaginable. Gold has entered a new price era. Silver is showing signs of powerful momentum, and the bond market is sending signals that investors cannot afford to ignore. The next move is not guaranteed, but the setup is impossible to ignore. If you own gold or silver, then this is exactly the kind of environment where patience and awareness matter more than emotion. Do not assume every rally will continue. Do not assume every correction means the bull market is over. Focus on the underlying trend. Focus on the financial system, and focus on what the market is telling you through the dollar and Treasury yields. If you found this analysis useful, then make sure you like this video and subscribe to Silver and Gold Watch. We cover the forces moving gold and silver, and we break down the stories behind the headlines in simple terms. I also want to hear from you. Do you think $40 trillion of US debt will push more investors toward gold and silver? Or do you think higher Treasury yields will eventually pull money away from precious metals? Leave your opinion in the comments. And if you are watching gold near $4,600 and silver near $70, then tell me which metal you believe has the bigger opportunity from here. This story is far from over. The next move could be one of the most important chapters in the precious metals market.